What's up, everyone, and welcome to the Daily Macro Update for Wednesday, December 3rd. Taking a look at the macro data for today, we got the private ADP jobs numbers for private jobs, and this saw the largest jobs cut since 2023. And so we saw that 32,000 jobs were cut from the private jobs ADP report. Let me just zoom out here a little bit. And this was the largest since 2023. So if we zoom out a little bit here, the last time we had a number similar to this was all the way back in March of 2023. And so as you can see, really since April of this year, we've had a large drop off in the private ADP numbers. And since we obviously don't have the jobs numbers from the government, for whatever reason they continue to, delay the jobs reports, we're still getting it from some of these private payrolls here, some of these other ones. And, this could be showing that the jobs market continues to be in contraction, or at least continues to change based off of the supply problem that continues to happen here. And again, we've talked about this in previous live streams, but, the combination of the current policy from the government with limiting immigration, as well as getting a tighter stance on immigration, as well as you have a lot of employers not hiring, so you're having a job freeze, right? So demand is also low. And then also, too, you have a lot of people leaving the labor market, mainly being led by the large amount of the boomer generation retiring. And so you're having a huge shrinking of the pool of labor. And this is causing a huge supply problem with the labor markets. And so you even have people like Scott Bessent, the current Treasury Secretary, over at the Treasury Department for the government, saying that, hey, we could be seeing, and also Jerome Powell over at the Fed has been saying that we could see a structural change with the labor market, where it could be normal that we have these lower jobs numbers because there really just isn't any type of, activity going on in the labor market right now. And so, it's interesting seeing that, as well as with, the birth rate declining. We could be seeing a flat jobs, environment similar to how Japan has theirs. And so this is pretty interesting seeing this dynamic, and it really shows how, a lot of the native population in the United States has not been contributing to the large amount of acceleration in the jobs numbers over the past few years. It's mainly been led by the open border policy from the Biden administration. So how great has been the labor market over the past 3 years? Has it been masked by the large amount of immigration, the mass immigration that's been happening over a few years? So maybe this has been going on the entire time, and we're just seeing it for what it is right now that the supply of immigration has been cut off. So the data on that is still new for this year, and so we'll see how that continues to form heading into 2026. But we'll see if this is something where the market is pricing it in similar to how it's pricing in tariffs, whereas maybe this weakening labor market was a big surprise in the beginning. Well, just like how tariffs were, but as we continue to get more tariff news, maybe as we get to have more of this slowing labor market news, it'll be less impactful as we go into 2026 with the markets. And so seeing that at the same time, we received, in my team's view, probably the most important leading economic index for the economy, which is the ISM Services PMI. This showed a 9-month acceleration that, we haven't seen this type of large acceleration in 9 months, which is really a huge indicator for the aggregate economy in the United States, because as we know, the services economy is, much more reflective of the aggregate economy, because the United States is a service-based economy. It is not a goods economy or a manufacturing type economy, like something like China. And so when taking a look at the numbers here, you can see that, it still remains in a slight contraction, because this needs to be above 50 to be considered this is actually looking at the employment number. So employment remains in contraction, but has had a 3-month acceleration, which is a positive rate of change. New orders has remained relatively flat and hasn't had too much of a change. It really had a little bit of a dip in May, but it has rebounded back to the average levels over the past few years. So new orders has come back. And then we're also seeing a pretty decent drop in prices, which is actually a little bit of a sign of a potential soft landing, because if you have demand staying strong or seeing a recovery in the services sector while prices are coming down, well, that is a clear sign of heading towards a more soft landing, right? Because what the market really wants to see is solid or steadily rising growth with inflation coming down. And so let me see, I thought I had the actual chart of it here, maybe not. That's all right, I can just pull it up here. So taking a look at the ISM Services PMI, we can see that this is the highest print that we've seen since February of 2025. And since September, it's had 2 months of a pretty strong rebound into expansionary territory. And so that is pretty positive for the services sector. And then also as well, we saw that industrial production had a pretty large acceleration in September. That has remained in positive territory, since January of this year. So industrial production on the rise, as well as manufacturing production has now posted 3 months of above 0% in a pretty confident way. If we zoom out over the past 3 years with manufacturing production, I mean, as you can see, it's been mostly in contraction since mid 2022, and is now showing some positivity here in 2025. So, all things considered, manufacturing production has started to improve. Industrial production is starting to improve, and we're now starting to see a rebound in the services sector, while prices have had a pretty interesting 1-month drop. All at the same time, where you have the Fed set to cut rates next week on December 10th. Right now, there's an 89% chance that they're going to cut by 25 basis points. And the probabilities of this continues higher as we get closer to the meeting. And so that's, this metric right here, the CME Group's Fed Watch tool becomes way more accurate as we get closer to that Fed meeting. And so it's likely that we are going to be seeing a cut by 25 basis points, and that's really what the market has been pricing in on this rebound that we are seeing right now. And then, interestingly though, seeing the Cleveland Fed's inflation nowcast, it's showing that core PCE is set to continue to rise. And we get the core PCE number for November this Friday. Hopefully we get the other numbers as well to catch all this up here. But that is showing an acceleration. And so if core PCE, which is the main inflation gauge that the Fed tracks and sets their policy on, with it being well above their 2% target, what's really going to cause them to cut rates further from here? And so we are still in this continuous battle between, is the market slowing down, or is it actually staying pretty firm? Which, in case if that's what's going on, why should the Fed cut further from here, or should they just go back into another pause phase like they keep doing over the past couple of years, where they will cut by about 75 to 100 basis points. They'll pause for 5 to 7 months, and then they'll continue another rate cutting regime. That's kind of what we're seeing right here with this rate cutting 2.0 cycle. So that's what we're seeing here on the macro. In terms of the actual charts here, as you can see, taking a look at the SPY, we have the trading range model for our group here. Top end of the trading range is between 690 and 687, and the low end of the trading range is between 669 and 664. And what's interesting is that still continuing on this bounce with it near the top end of the trading range, we're seeing a deceleration in volume. So we're continuously seeing that bearish divergence. And so if you're feeling like, oh man, I missed out on this bounce, the bull market is back, what the heck am I doing? Don't worry, give yourself some grace as well as some patience, because we are still continuing to see this bearish divergence here. And so the correct move with this signal is to continuously raise cash, sell some into strength, clear out any losers that have broken trend and that are, that you're still bag holding, right? These are just presenting more opportunities here to, clear out any of the losers that have been breaking trend in your portfolio. And so, let's see here. Somebody is saying that the microphone is not good. Let's see. All right, let's try that one. That'll probably fix it. You see, I don't know why my streaming software here does this. It always mixes up some type of setting that I have in here, but that should fix it. So apologies if that was a little bit scratchy there, or if it sounded a little bit distant. But continuing here, what's interesting too is that, we're seeing the dollar starting to break trend here, right? So the dollar has been in a bullish trend for pretty much since when they started to cut rates back in mid-December, which is interesting. Now that they are continuing to cut rates, we're seeing a little bit of a dollar drop, and it's clearly breaking its bullish trend right here. We're also seeing bond yields start to come down again. And really, they've pretty much stayed flat, even though it's had some crazy ups and downs. Bond yields, or interest rates that you and I pay for, have remained relatively flat since the Fed has started cutting rates, which is suggesting to me that the bond market is not agreeing fully with the Fed's decision to enter into a rate cutting 2.0 regime here. So we have to continue to monitor that. But in terms of risks, I'm sure you've seen over across the X space, Twitter space, FinTwit, that a lot of people have been posting about the rise in Japanese bond yields and the risks that entails. Really it's the narrative of the yen carry trade causing a huge problem for markets all across the globe. But in actuality, when we take a look at the different, credit spreads, as well as other things that are showing, financial stress, we're not necessarily seeing that just yet, right? So, credit spreads still remain pretty narrow. But one of our members yesterday did point out that when taking a look at the spread between SOFR and the IORB, so that's the securitized overnight funding rate, as well as the interest on reserve balances. We can see that this is still accelerating. So we are still seeing continued financial tightness in terms of funding, but in terms of credit stress, we are not seeing that just yet. So it's not like these risks are completely, we should completely ignore them. It's just, in terms of them materializing into risks in the market, we're just not seeing that just yet. And from what I've learned over the past few years is that, even though there are apparent risks that are out there in the markets that, we can keep in the back of our mind, that does not mean that we go against the current trend that we are seeing in the markets and bet against it. You always want to make sure that you are favoring what the markets are telling you in conjunction with all of this data. Sometimes the risks and the data, as well as what's happening on the charts, align, but really you want to give priority to what the pricing markets are actually telling you, which as of right now, it's not really seeing the Japanese bond yield acceleration as a problem at this point in time. That could change, but it's not necessarily a signal in order to panic. Okay, so with all the narrative that's floating out there, definitely fade that and don't just let those people who have marketing newsletters, glorified marketing newsletters, to get you to feel a lot of feelings. Okay, let's stay grounded. Let's make sure that we are based in reality here, and making sure that we are not just panic selling. But just because that we're having a little bit of a rally in things like the S&P 500, we are continuing to see other types of names that are having a large breakout, such as copper miners. COPX is the ticker there. Natural gas, UNG is the preferred ETF that my team and I like to use. We have copper, CPER, steel, VanEck Steel ETF, SLX, the DBB Base Metal Fund. We also saw, let me see here, let me go down to gold. So gold looks like it's going to continue to break out, as well as silver, which, I mean, silver has already broken out. This is one of the call outs that we've been talking about in our group over the past couple weeks here. Good time to sell some silver, as it's having a pretty crazy standard deviation acceleration here. Don't get rid of it, but, take some off the table there in order to buy lower. And yeah, a lot of these other metals as well, platinum, palladium, all these other miners. Really interesting seeing all of that there, as well as almost potentially seeing a bottom in Bitcoin here. Now, Bitcoin is still technically in a bearish trend according to our model, but this is near the top end of the trading range on not great volume. So even if you were wanting to get back into Bitcoin, or if you were itching to get back into it, our model isn't saying do that just yet. If anything, this is where you would sell a little bit just to see what happens after this. And so we're still using Bitcoin as a key macro indicator for inflation, because if this ends up starting to spike up, then that would be the markets trying to price in either easing liquidity conditions and inflation rising, or if it ends up rejecting from here, continuing to see those tightening financial market conditions, as well as more of a stagflationary type of environment. So a little bit of a better signal from Bitcoin. Still hasn't changed into bullish trend from its bearish trend, but in a very near-term basis, it is having some positive signs here. So that will be something that we keep our eye on. Yeah, pretty much the only thing that's having a pretty decent jump is Tesla here on accelerating volume at the top end of the trading range. Still, when something pumps to the top end of the trading range, you do not want to just start trying to chase this. That is the exact opposite move that you want to do right now. And so if you are chasing Tesla into the close, then you really need to start thinking about the markets in terms of risk management, because if you're just trying to bet on probabilities, you're not giving yourself very good probabilities from here. It definitely could happen where Tesla could keep, accelerating from here and push up the top end of the trading range, but this isn't necessarily the ideal position if you're trying to look for the most upside compared to downside. And so really the thing that my team and I have been focusing on is the little bit of a correction here that we're seeing in the most bullish sector right now, which is the healthcare sector. We expressed that with the ETF XLV here, and that had a little bit of a pop, but we could see some further correction down to the low end of the trading range, which at the timing of this video is around $152 per share of XLV. Seeing a little bit of a slight deceleration in volume. I would like to see this come down closer to the low end of the trading range on more lower volume before I make a heavier position there, but that's what I'm seeing. So there are still some opportunities that we're seeing in the markets that are way better than just chasing a lot of the things that have been bouncing, that have been performing poorly over the past few weeks. So in summary, today's macro picture is showing a weakening labor market, but still strong activity data, specifically in industrials, a little bit in the production for manufacturing, and then the services sector, according to the ISM service PMI, is showing a very strong rebound there. All of which, is happening while inflation is remaining near 3%, well above the markets, well above the Fed's target for 2%. The Fed is cutting into that for some reason. And because of this, risk assets are having a little bit of a rebound on that viewpoint. So interesting seeing Bitcoin catch a bid. And so the only thing that I would be just noticing here is, because volume is still relatively low, this is not a sign to chase any of this at all. It's a good signal, and maybe, it should perk your ears up to see if we end up going into a full-blown risk-on type of environment. But This is still needing to do some work before it convinces me otherwise. And so don't chase, hold the emotion steady, and wait for and be patient for an opportunity, a real opportunity here. So that is really the message for today. Let's see here. If we take a look at some of the things that have been also having the biggest rally here today in terms of the best ETFs, the Ethereum ETF, ETHA, that has had one of the largest accelerations today, but really it remains in a bearish trend. So do not want to chase any of that. Oil, XES. So the equipment and services ETF for oil, that has been also one of the best bullish trends since the bottom here. And so that's had a pretty large acceleration. Anytime this has a dip, it's good to buy. And so that's what we're looking at there. And then we already covered copper miners. So those are the better performing ones today. And really the worst performing ETF that I was seeing today that is on the list, that could be a possible short, is the Philippines ETF, EPHE. So this is an example of something that's in bearish trend where you got a little bit of a short opportunity over the past week or so, right around here, and then as this continues to drop, that's where you would cover some. If you're someone who trades options, maybe you would buy put options or sell calls at that moment. Really, it doesn't matter how you express the bearish trade, but this is a perfect example of something our process would identify as a bearish trend, and then waiting for that opportune time of a bounce before hitting the bearish button, whatever that means for you. So with that, we'll go ahead and take some questions here. I apologize at the beginning of this stream with the audio problems, but yeah, let's go ahead and take a look at some of the questions here. How do you have the trading range bands on your chart? So that specifically is my team's own trading range model that we developed ourselves. And this is available on demand as a user license for those people who are in our either 6-week challenge or who are partners with us in our Partnership Circle program. If you guys would want access to this for a 6-week trial, right now we're continuing to do our 6-week challenge, which is where you get full access to our Partnership Circle. During the last Black Friday sale, we had some people take advantage of that internally. And so a lot of spots opened up for the 6-week challenge for the remainder of December. And if you guys would want to learn more about that, just go to the link in the description below. For those that are on X or Twitter, just go to my website. You can find it there. Send me a DM. I'll send you my calendar link. We can hop on a quick call just to go over the details to see if it's something that would help you. And then, yeah, we can go from there. For those who are on TikTok as well as Instagram, just go to the link in the bio there. Why do you think volume has not come back? Is there any signal, macro or otherwise, to be on the lookout for? I mean, it really doesn't matter the reason why volume hasn't accelerated from here. What matters is that what we're observing, which is that volume continues to decelerate while prices continue to have a bounce closer to the top end of the trading range, which is just a classic bearish divergence signal, which that doesn't mean that we're bearish on the markets. What a bearish divergence means is that it's a very weak acceleration in prices, right? So it's not like buyers are fully convinced on this bounce, okay? And so you want to pay attention to those different divergences. And it's not just looking at divergences between price and volume. You also want to be looking at divergences in volatility, as well as in correlations. All those different things should be coming into consideration when you're taking a look at any asset, right? And so That's really what I'm looking at here. So we're still seeing some higher volatility, but this huge drop off in volume that we're seeing right now on this price acceleration. What this is telling me is that you do not want to chase this right here. So, good question though. Yeah, at some point, volume is going to come back. We'll see what that form is, whether that's prices accelerating to new all-time highs. Which in that case, if volume does come back on that, great. It's shown to gain more momentum, and so I have no problem buying on a dip on lower volume. But typically, what the higher probability is from here, when you see a price bounce on lower volume, typically what you see is some type of correction as volume comes back. So now that could be where, let's say that, towards the second half of the week here, we see a little bit of a correction in the S&P 500. Maybe that comes back to, one of these levels here, one of these key levels of support and resistance. And then maybe it has, one more day on lower volume near the low end of the trading range. Well, then from that point, my team and I would be looking for other positively correlated assets to the S&P 500, whether those are ETFs or stocks that are also near the low end of the trading range on lower volume. And then that's where you would want to start to make some positions. And then also too, if that happens, you also want to pay attention to what bond yields are doing, what the dollar is doing, because if the dollar continues to go down in a down market, that could be more of a signal to also have more exposure to some of the other things that are having corrections. These are all things that we tackle in our macro investing community, by the way. So if this all seems like a lot of work that you have to do, that's because it is, but we do help make it way more easier for you in the community. Good question. Good question. Let's see, any comments here on Instagram? What's the cause of the bump in IWM today in small caps? I don't know what it was. It could have been the better than expected services numbers. It could be the expectation that, because we got, worse than expected ADP jobs numbers, maybe that's a further convincing the markets that they're going to cut interest rates. Who knows? Really, what we want to pay attention from here is what bond yields will do even if they continue to cut rates. Because if they cut rates and bond yields rise from here, that's something that would cause the markets to definitely begin another correction. NVIDIA has been weak. Yeah, the semiconductor space has had a little bit of a trouble. NVIDIA specifically, yeah, this has pretty much remained flat for a while here. It did have a little bit of an acceleration there at the end of October, but then ever since it has had a price decline back to the same prices that it's been nearly since the end of July. So yeah, something like NVIDIA that has is pretty liquidity sensitive. It's something where it's like, man, why would I just bag hold something that's been going sideways for nearly 6 months when I could have been holding on to something like biotech, which has been doing the exact opposite. That's been going up in a straight line, right? This is the importance of having a macro perspective so that you can look for different opportunities while other things in your portfolio might just be going sideways because your portfolio or that specific position in your portfolio hasn't been making you money. And that's not good. You don't want to be just holding something while it's going sideways. Even if you like it, even if you have some type of emotional ties to it, which I don't recommend you do to any of these types of tickers. But if things are going sideways, you want to make sure that you're owning things that continue to help out your portfolio there. So, yeah, just one of those things here. What's interesting is that the broader semiconductor space, looking at something like the SMH, which is the VanEck Semiconductor ETF, that looks more like a chart of small caps, you know, very similar. But again, when taking a look at volume here, volume hasn't really come back. I mean, it's close to the average, but still it's been on a decent deceleration. So again, this bounce that we're seeing right now, you do not want to chase it. You want to make sure that you want to be, taking some profits. Like let's say you owned small caps, IWM, all the way down here, and it's had this pop to the, near all-time highs, then, this is a great opportunity to consolidate that. All right, let's take a look at some of the questions here on TikTok, and then we can go ahead and wrap it up. Let me just scroll down here, see which questions that are on here. UNH seeing some strength. Do you think it is a swing to the top in the trading range to the 370 region? Yeah, I mean, United Health technically is still in a bearish trend, so it's not something that I'm touching currently. It's been a little bit wild. So, but good question, Georgios. Appreciate the likes. Helps out the algorithm. Do you think silver comes down and consolidates for 30 years again before making new all-time highs? Laugh, cry. Yeah, I'm not sure if that's going to happen. Fair value Gary. Diamond hands emojis. Nice username there. It seems like silver will continue. I mean, it's the strongest, bullish trend right now, along with healthcare. So completely beating out gold, by the way. The silver to Bitcoin, or I'm sorry, the silver to gold ratio, like we see on this chart right here, this is a massive breakout versus gold. And really, when taking a look at this ratio, silver has been bullish on gold pretty much since late June. So that's why it's important to make sure to pay attention to these ratios whenever you're deciding, like, should I own this thing or should I own that thing? Well, you can create a ratio of those two decisions within TradingView and have this, like a chart, tell you if it's something that's in a bullish or bearish trend. And there you go. There's your decision. You can pick any two assets and do it that way, right? It's like fantasy football. Should I start silver this week or should I start gold? Well, silver's in a bullish trend, so you start gold. So yeah, I mean, silver has had a pretty large acceleration. So if anything, it's good to take some profits on this. Not completely sell out of it if you have a core position, but if it comes back down or consolidates for the next couple weeks after this, then yeah, continuing to buy some when it reaches that low end of the trading range. Good question. How are you factoring in the skipped government labor and CPI reports? Well, we still have private data, so we still have to look at those. And then also as well, you can just take a look at the price charts because really, the CPI data, the government data, it's very lagging. By the time that comes out, the markets have already priced in that data. Sometimes it prices it in too much or too little, and then you have some fluctuations in the very near term on the reaction of the data releases. But pretty much the currency markets, bond markets, as well as the equity markets do a pretty good job with pricing in a lot of that data because, unfortunately, insider trading does happen. And, the markets, if you're looking at everything from a macro lens, will give you that story. So really, what we want to look at is what is the market telling us in terms of growth and inflation, as well as government policy, as well as liquidity, as well as monetary policy. And then is the lagging real data that comes out supporting that or not supporting that? And so really the government data, the private data, the real numbers, right, the survey soft data, those are just things that will either confirm or deny the trends that we're seeing in the price charts, right? And so it's not the end of the world that we're not getting some of this government data, although it would help provide a more clear picture and a better confirmation, because if we're not getting that government data, it could lead to more volatility in the markets just because the markets may not be able to, price in the data better. So, again, it's not the end of the world, but, just pay attention to the price charts. That'll pretty much tell you what's going on. Good question. Yeah, I mean, when taking a look at the 5-year break-even inflation rates, that's starting to continue to come down to that lower level that we saw all the way back in the middle of October. So, this is something where this could be some added pressure on some more added downward pressure on Bitcoin's price, which is why, Bitcoin, even though it's showing some better signs, less weak signs, Bitcoin loves it when inflation is going up. And right now, that's not what we're seeing. Can you show the ranges for SLV? Sure. Yeah, so silver, SLV, ETF, right at the top of the trading range. This is absolutely not a time to just, try and chase this and buy right here. Okay. It's right at the top of the trading range. So, yeah, don't chase. Now, if you guys want, we do have a $15 a month offer where every single week I send you the ranges for Bitcoin, gold, silver, oil, the dollar, as well as 10-year government bonds, as well as we provide you with a pretty in-depth update on the current macro trend, the best bullish thing to own, the worst bearish thing to avoid or short, as well as our thoughts heading into the week. And that comes out every single Sunday before the Sunday macro wrap up. And so that, as well as you get access to our macro investing training that is in our community. And then you also get the archived full version of the Sunday macro wrap up that we have offline that you can join. So all of that, for just $15 a month, you can go on our website, macro-optics.com, and you can check it out there. Yeah, that's great for people who are just trying to, get an introduction into macro. But we are coming up on 4:25 here. We'll go ahead and wrap it up there. I appreciate everyone for joining. It's been a pretty busy last few days, so I haven't really had a chance to make too many short videos. I will try and make some of those here in the next few days. Just been super busy, but typically that happens towards the holidays here. So yeah, be on the lookout for more good in-depth short videos. But until then, I will catch you in tomorrow's daily macro update. Bye, everyone.